Bank of America just surrendered. Not quietly, not gradually, publicly, officially, completely. The largest silver shorter in modern history, the bank that paid hundreds of millions in fines for manipulating precious metals markets, the institution that told investors for years to avoid silver, just issued a research note forecasting silver could reach $309 per ounce. $309. Let that sink in. The current price is $78. They are forecasting a 400% increase from current levels, and they are not alone. Goldman Sachs raised targets. JP Morgan went silent on their short thesis. Credit Suisse reversed their bearish stance. The entire banking cartel that suppressed silver for decades is now flipping bullish at the exact moment when physical metal is disappearing from the market. This is not capitulation. This is panic. And it proves everything the silver squeeze community has been saying for years. The shortage is real, the manipulation is ending, and the price is going vertical. But the story is not just about forecasts. The story is about what is happening in the physical market right now, today, while most people are still watching paper prices on screens. Physical silver premiums have exploded. Dealers that used to charge 2 to 3% over spot are now charging 30 to 40%. Some products are 50% over spot, and even at those prices, inventory is vanishing. Wait times that used to be days or weeks are now 2 to 3 months. Some dealers have stopped taking orders entirely because they cannot secure supply. The American Silver Eagle, the most popular coin in the world, is effectively unavailable at retail. The Canadian Maple Leaf is back ordered for months. Generic rounds and bars are the only products moving, and even those are becoming scarce. This is not normal market behavior. This is the beginning of a physical shortage that the paper market can no longer hide. Let's start with Bank of America because their surrender is the most significant signal yet that the game has changed. Bank of America has been on the wrong side of silver for over a decade. They held massive short positions through their commodity trading desks. They issued bearish research notes telling clients that silver was overvalued, that industrial demand would weaken, that mining supply would increase, and that investors should avoid exposure. Every major rally was met with Bank of America research explaining why it could not continue. Every dip was used as evidence that their thesis was correct. But behind the scenes, their positions were bleeding. Every time silver spiked, they lost money. Every time physical demand surged, their ability to cover shorts at favorable prices diminished. And now, with China restricting exports, with COMEX inventories at multi-year lows, with physical premiums exploding, they have looked at their risk models and realized they cannot maintain their position. So they flipped. Not subtly, not with a gradual shift in language. They went from bearish to forecasting the highest price target in the industry, $309 per ounce. The research note itself is worth examining because it reveals how desperate the situation has become. Bank of America analysts cited 5 primary drivers for their bullish reversal. First, supply deficits that are structural and persistent. They acknowledge that global silver production has peaked and cannot increase meaningfully in the short to medium term. Mining is not responding to higher prices because the lead time for new projects is 5 to 10 years. Recycling cannot fill the gap because most silver is consumed in ways that make recovery difficult or uneconomical. The deficit, which they now estimate at over 250 million ounces annually, will persist for years. This is a complete reversal from their previous stance that supply would balance demand. Second, industrial demand that is accelerating beyond all forecasts. Bank of America specifically highlights solar panel production, electric vehicle manufacturing, and 5G infrastructure as demand drivers that are non-discretionary and price inelastic. They note that China alone is installing solar capacity that requires more silver annually than total global mining production. This is a staggering admission. It means that even if every other use of silver disappeared, solar demand from one country would create a shortage. Add in electric vehicles, electronics, medical devices, and all other industrial uses, and the math becomes impossible. There is not enough silver being mined to meet industrial needs, let alone investment demand. Third, they acknowledge the breakdown of the paper market. This is the most significant part of the note. Bank of America admits that the futures market no longer reflects physical reality. They point to the widening spread between COMEX prices and physical premiums. They note that arbitrage is failing to close the gap. They describe a market where paper contracts trade freely, but physical delivery is increasingly difficult. This is a bank that profited from the paper market for decades, now admitting that the paper market is broken. The implications are enormous. If the futures market cannot set prices, then price discovery moves to the physical market. And in the physical market, supply is disappearing while demand is exploding. The result is vertical price moves. Fourth, geopolitical competition for resources. Bank of America notes that governments are now treating silver as a strategic material. China restricting exports, the United States building domestic refining capacity, and other nations implementing their own resource protectionism policies, all point to a world where free market forces are being overridden by national security concerns. When governments compete for resources, price becomes secondary to availability. This creates bidding wars that push prices far beyond what traditional supply and demand models would predict. Bank of America is now pricing in this geopolitical premium. Fifth, and perhaps most tellingly, they acknowledge that their own positioning was wrong. The note does not explicitly say they were short and are now covering, but the language strongly suggests it. They reference learning from past mistakes, updating models based on new realities, and recognizing that market structure has changed in ways that invalidate previous assumptions. This is as close to an admission of defeat as a major bank will ever make publicly. They got it wrong. They lost money. And now they are reversing course to avoid losing more. The $309 target is not pulled from thin air. It is based on a scenario where the supply deficit persists for 3 years, industrial demand continues growing, investment demand increases as safe haven flows accelerate, and governments compete for remaining supply. In this scenario, price must rise to a level where demand is destroyed, where factories cannot afford to use silver and must find alternatives or shut down, where investors are priced out of the market, where only the most critical applications justify the cost. Bank of America. This model suggests that level is somewhere between $135 on the low end and $309 on the high end. They are not saying silver will definitely hit $309. They are saying that if current trends continue, the market clearing price could be that high. And given that current trends are accelerating rather than slowing, the high-end scenario is increasingly likely. Now let's talk about what is happening in the physical market, because this is where theory meets reality. The premium explosion is not a new phenomenon, but the speed and magnitude of the current move is unprecedented. 6 months ago, a typical American Silver Eagle sold for $3 to $4 over spot. Today, if you can find one, you're paying $12 to $15 over spot. That is a premium of 15 to 20% on a $78 spot price. For generic rounds and bars, premiums that were 50 cents to $1 are now $5 to $8. The premium on 10-ounce bars has gone from 1% to 25%. The premium on 100-ounce bars, which used to trade closest to spot because of lower fabrication costs, is now 10 to 15%. These are not temporary spikes driven by short-term demand. These are structural premiums driven by the inability of the supply chain to deliver physical metal at anything close to the paper price. Dealers are caught in an impossible position. They can source some metal from wholesalers, but wholesalers are charging premiums that eliminate dealer margins. If a dealer used to buy a Silver Eagle for $2 over spot and sell for $4 over, they made $2 per coin. Now they are buying for $10 over spot and selling for $12 over, still making $2 per coin, but on a much riskier inventory position. If spot price drops, they lose money on existing inventory. If spot rises faster than they can replenish, they run out of product. Many dealers have responded by raising premiums even higher to protect margins and to ration limited supply to serious buyers. This creates a feedback loop. Higher premiums attract more sellers of existing inventory, but those sellers are immediately replaced by new buyers who view the premiums as confirmation that physical shortage is real. The net result is that premiums keep rising even as some metal changes hands. The wait times tell an even more alarming story. In a normal market, a dealer takes an order, pulls inventory from their vault, and ships within 1 to 3 business days. Right now, dealers are quoting 6 to 12-week delivery times for common products. Some are being honest and saying they do not know when they can deliver, because they do not know when their suppliers can deliver to them. This has created a secondary market where individuals with physical silver are selling to other individuals at premiums above dealer prices, because the buyer does not want to wait months. Private party transactions on forums and social media are happening at 15 to 25% premiums. People are paying $78 spot plus $20 premium to buy from another individual because they cannot get metal from traditional channels. This is the definition of shortage. When buyers are willing to pay far above market price and still cannot find supply, the market price is wrong. The mint situation adds another layer to the crisis. The United States Mint, which produces American Silver Eagles, has been unable to meet demand for over a year. They have implemented allocation systems where dealers can only order a fraction of what they request. Some months, allocations are cut by 80%. The mint blames blank shortages. The blank producers blame silver shortages. The silver producers point to mining constraints and refining bottlenecks. Everyone in the supply chain is pointing at someone else, but the end result is the same. The most popular silver coin in the world is effectively unavailable at reasonable premiums. And when the government mint cannot supply coins, it sends a signal to the market that supply really is constrained. Other sovereign mints are experiencing similar issues. The Royal Canadian Mint has wait times for maple leafs. The Perth Mint in Australia is rationing sales. Private mints that used to have quick turnaround are now quoting months for delivery. The entire production infrastructure is maxed out and still cannot keep up with demand. And this is before the general public even realizes what is happening. Right now, the buyers are informed investors, preppers, and traders who follow precious metals closely. If mainstream awareness increases, if headlines start appearing about silver shortages, if celebrities or influencers start talking about it, the demand surge could be 10 times larger than what the industry is currently struggling to handle. The system cannot absorb that shock. It will break completely. This brings us to the most important question. Why are physical premiums exploding now when the paper price is only at $78? The answer is that the paper price and the physical price have decoupled. They are now two different markets. The paper market is where banks and hedge funds trade contracts for future delivery that will mostly be cash settled. The physical market is where industrial users, investors, and governments compete for actual metal that exists today. The paper market can expand infinitely because creating a contract requires only a keystroke. The physical market is constrained by mining production, refining capacity, and existing above-ground stockpiles. When these two markets diverge, the premium is the gap between fiction and reality, and that gap is widening rapidly. The COMEX situation illustrates this perfectly. COMEX registered inventory, the silver available for immediate delivery against contracts, is currently below 100 million ounces. Open interest, the number of contracts that could demand delivery, represents over 600 million ounces. If even 20% of contract holders demanded physical delivery, the exchange would default. It would not have the metal. This is why COMEX has mechanisms to force cash settlement, to change rules during crisis, and to halt trading if necessary. The exchange is not designed to deliver physical metal to everyone who holds a contract. It is designed to provide a pricing mechanism and a hedging tool for producers and consumers. But increasingly, people are realizing this. They are realizing that a COMEX contract is not the same as a bar in a vault, and they are choosing physical over paper. The Shanghai Premium, which we discussed in previous videos, is another manifestation of the same phenomenon. Physical silver in Shanghai trades consistently higher than COMEX futures because Chinese buyers need physical metal and are willing to pay more for certainty of delivery. The gap between Shanghai and COMEX is the market's way of saying paper promises are not the same as tangible assets. And as long as that gap persists, arbitrage will drain metal from west to east until either Western prices rise or Western supply disappears. Both are happening simultaneously. Bank of America's $309 forecast is essentially a recognition that if current trends continue, the paper market will collapse entirely. The price will be set exclusively by physical supply and demand. And in a physical-only market, $78 is nowhere close to the clearing price. The clearing price is where supply equals demand. Right now, supply is constrained and demand is surging. The clearing price must be higher. How much higher depends on how long the shortage lasts and how elastic demand proves to be. Bank of America is suggesting that in a sustained shortage, the clearing price could be 4 times current levels. They are probably being conservative. Let's examine what happens at $309 per ounce. First, mining becomes extraordinarily profitable. Companies that are marginally profitable at $78 would be minting money at $300. But profitability does not translate to production increases overnight. Mines cannot simply flip a switch and double output. Ore grades are fixed, processing capacity is fixed, labor and equipment availability are fixed. A mine producing 1 million ounces per year at $78 will still produce roughly 1 million ounces per year at $300, just with much higher margins. Those margins will eventually fund expansion projects, but those projects take 5 to 10 years to complete. In the short to medium term, higher prices do not increase supply meaningfully. Second, industrial users face a crisis. A solar panel manufacturer using 1 ounce of silver per panel at $78 has a materials cost of $78. At $309, that cost is $309. The manufacturer has 3 options: eat the cost and destroy margins, pass the cost to customers and lose competitiveness, or reduce silver content and sacrifice efficiency. None of these options are good. Many manufacturers will try to reduce silver content, which has been a trend for years. But there are limits. Below a certain amount of silver, panel efficiency drops significantly, making the panel less attractive to buyers. The industry has already reduced silver content by 60% over the last decade. Further reductions are difficult without major technological breakthroughs. Some manufacturers will simply shut down if they cannot secure silver at viable prices. Third, investment demand explodes. At $78, silver is already attracting significant investment interest. At $309, it becomes one of the best performing assets in modern history. Retail investors who ignored silver at $30 will panic buy at $200. Institutional allocators who dismissed silver as too volatile will add positions when momentum is undeniable. Sovereign wealth funds will treat it as a strategic reserve. This creates a self-reinforcing cycle. Rising prices attract buyers. More buyers push prices higher. Higher prices attract more buyers. The cycle continues until something breaks the momentum. Historically, these cycles break when a major exogenous shock occurs or when central banks intervene aggressively to change the narrative. But in a world where central banks are printing money to fund deficits, intervention to suppress commodity prices is difficult without causing other problems. Fourth, the wealth transfer is staggering. Anyone holding physical silver bought at $30 and selling at $309 captures a 10 times return. On a 1,000 ounce position, that is a $250,000 gain. On a 10,000 ounce position, it is $2.5 million. For individuals who recognize the shortage early and accumulated metal, this is generational wealth creation. For institutions that shorted silver or stayed underweight, this is catastrophic loss. Bank of America's reversal is partly about avoiding being on the wrong side of that wealth transfer. They do not want to be the bank that lost billions shorting the metal that went up 400%. Fifth, the political and social ramifications become severe. A 400% increase in silver prices means a 400% increase in the cost of green energy infrastructure. Solar becomes more expensive, electric vehicles become more expensive. The entire energy transition that governments have mandated becomes economically harder to justify. Politicians who promised affordable, clean energy face backlash. Industries that relied on cheap silver face disruption. Trade wars intensify as nations compete for supply. The geopolitical consequences ripple outward in ways that are difficult to predict, but almost certainly destabilizing. Now, the critical question for anyone watching this video: what do you do with this information? Bank of America is forecasting $309. Physical premiums are 30 to 40% over spot. Dealers cannot source inventory. Wait times are months. The signs of shortage are everywhere. The window to act is closing. What is the correct positioning? The answer depends on your situation, your risk tolerance, and your time horizon. But some general principles apply. First, if you do not own physical silver and you believe the shortage thesis, the time to buy is now, not later. Premiums are high, but they are going higher. Wait times are long, but they are getting longer. The pain of paying 30% over spot today is far less than the pain of trying to source metal at any price 6 months from now when retail supply is completely dried up. Second, if you own physical silver and you are wondering whether to take profits at $78, consider what Bank of America is telling you. The largest suppressor of silver prices is now saying the upside is 400%. They have more information, better models, and greater insight into institutional positioning than retail investors. If they are capitulating and flipping bullish, what does that tell you about the probability of significantly higher prices? Taking some profit to de-risk is always reasonable, but selling core positions before the real move begins is a mistake that cannot be undone. Third, if you are considering paper silver like ETFs or futures contracts, understand the risks. SLV, the largest silver ETF, is having trouble sourcing physical metal to back new shares. If redemptions surge or if supply shortages worsen, the ETF may not be able to deliver. Futures contracts are even riskier because exchanges can change settlement rules, impose position limits, or halt trading. Physical possession eliminates counterparty risk. It eliminates the risk that someone changes the rules. It eliminates the risk that your claim on silver turns out to be worthless because the metal does not exist. In a shortage, physical is the only thing that matters. Fourth, focus on liquidity. Not all physical silver is equally liquid. Government-minted coins like American Silver Eagles, Canadian Maple Leafs, and Austrian Philharmonics have the highest liquidity because they are recognizable and trusted worldwide. Generic rounds and bars are less liquid but still tradable. Numismatic or collectible coins have additional value based on rarity, but are harder to sell quickly at fair prices. In a shortage environment, liquidity is critical because you may need to sell quickly or you may want to trade silver for other assets. Stick to the most liquid products unless you have specific reasons to do otherwise. Fourth, focus on liquidity. Not all physical silver is equally liquid. Government-minted coins like American Silver Eagles, Canadian Maple Leafs, and Austrian Philharmonics have the highest liquidity because they are recognizable and trusted worldwide. Generic rounds and bars are less liquid but still tradable. Numismatic or collectible coins have additional value based on rarity but are harder to sell quickly at fair prices. In a shortage environment, liquidity is critical because you may need to sell quickly or you may want to trade silver for other assets. Stick to the most liquid products unless you have specific reasons to do otherwise. Fifth, storage and security become more important as values increase. If silver goes to $309, your stack is worth 4 times what it is today. That increased value makes you a more attractive target for theft. Home safes, safe deposit boxes, and professional storage all have trade-offs. Home storage gives you immediate access but requires security measures. Safe deposit boxes are secure but may not be accessible during bank closures or crises. Professional storage offers insurance and security but introduces counterparty risk. The right choice depends on the size of your holdings and your personal situation. But ignoring security because silver is cheap today is a mistake that becomes costly when silver is expensive tomorrow. The final point is psychological. Watching silver go from 78 to 309, if it happens, will not be a smooth ride. There will be pullbacks. There will be moments of doubt. There will be media narratives trying to convince you the top is in and you should sell. The ability to hold through volatility requires conviction. That conviction comes from understanding why you own silver in the first place. If you own it because a YouTube video told you to, you will sell at the first sign of trouble. If you own it because you understand the supply deficit, the industrial demand, the geopolitical competition, and the breakdown of the paper market, you will hold through volatility because the thesis has not changed. Bank of America's surrender is validation of the thesis. It is confirmation that the largest skeptics are now believers. It is proof that the shortage is real and the price is going much higher. The premiums exploding, the dealer shortages, the mint allocation systems, the widening gap between paper and physical, all of it points to the same conclusion. The silver market is breaking, the suppression is ending, the true price is being revealed, and that price is far higher than $78. Bank of America says it could be 309. They might be right, they might be conservative. The only certainty is that physical silver is becoming harder to find and more expensive to buy. And those who wait for confirmation, who wait for the mainstream media to tell them it is safe to buy, will find that the metal is gone and the opportunity has passed. The time to act is not when everyone agrees. The time to act is when the signs are visible but the crowd has not yet moved. That time is now.